Bitcoin has reached the pivot, the moment where the entire next chapter of the cycle gets decided. We got three scenarios, one decision, 93K ignition, 78K clean reset, spike to 69 maximum fear entry. You don't get to choose the path, you do choose your positioning. And today, I'm going to show you exactly what those paths look like. And we're also going to be incorporating the bond market because the bond market itself is making some decisions that we have to keep our eye on. The Fed, the liquidity signals are all flashing at the same time. This, I think, is going to be one of the most important episodes that I do on the year. Well, the year is ending quickly, but let's get right into it, Crypto Crew. All right, it's your boy Tom here, bringing you the hottest in Bitcoin and crypto action. If you like what you see, give us a like. Make sure you hit subscribe if you have not already. If you've been mad or something, or you've been someplace under a rock, make sure you hit subscribe. Tell your friends about us. Make sure you come on over to X and follow us on X, where we talk about Bitcoin, crypto all day, every day, because we are crypto maniacs. All right, let's get it all down. Let's break it all down for you, because Bitcoin is at the pivot point, right? This is the points that we're saying that we're outlining for you, but we have a twist. And coming from the perma bull, I'm going to tell you that we need to pay attention to the 10-year bond yield, because that could change everything for us. So the perma bull is saying, okay, we look like we're going higher. Fed rate cut is really at like 87% right now. But the perma bull is saying we got to be cautious, right? So, I'm a trader. I'm not a perma bull. I'm a trader just like you. Tired of hearing it. Right now, overall, we've been kind of correct. And we said we had a 71% trading, win rate last week, and we're doing pretty well this week too. So make sure you get in on our pro group, and we'll show you what we do. We got no problem trading naked in front of anybody. Okay, trading naked is really difficult. Really, if you think about it, you're sitting there, you're making trade calls. Everyone gets to see your little Willie. You got all the, the birthmarks on your back and stuff that you have to be concerned about. Maybe the hair coming down, your shoulders. Now, that's not me. All right. I'm just making a really ugly scenario for you to actually, think about it. When you have to make trade calls, it's pretty difficult, right? Because you're not the only one that sees the error, right? Or the loss. It's not even error, right? It's just because trading's probabilities. But anyway, I digress. Anyway, let's start with the chart that sets the entire tone for the episode. Hopefully nobody spit out their coffee on those imageries that I just put out there. But anyway, we got three scenarios. We got one decision. 93K, we got ignition. Okay, so I think, you know what? I think Frank's being a little irrationally exuberant with the 93K. I'd have to say 95K, and then we got the launch scenario coming in. So a breakout above that and a reclaim, we got to run towards the next liquidity wall. Now he's got like 95. I'm thinking more like 99, 102. So then we got the 100,000 is obviously the psychological level. So if demand steps in, this becomes the beginning of the next trend expansion. Okay, now we could also, because what we're thinking is we're going to get a delayed reaction. That's CZ. I'm not ready to talk to him about him yet. But we could get a delayed reaction. All right. Whereas we get the FOMC rate cut, and then we could get actually the market actually to sell. You buy the rumor, sell the fact. We could get that to come off. So we're looking at potential maybe a couple of days later for the market to actually absorb it and then do the next movement up. So we could go down to, all right, a $78,000 point. I really would not like to see that, but it's potential. 80 to 78K really deep retrace. That main support level before the pop, that would be, a very healthy scenario. Bitcoin revisits like a structural support, retests open interest, shakes out weekends, and resumes an uptrend. Mid-cycle dips are always violent every single cycle. So now we're coming to the end, coming to the end of the year where people are looking to take profits or do things for taxes, but things can get violent down here. Now, a spike down to 69K, we got a maximum fear entry point. Now, this is all going to depend on one thing. Okay? Now, right now, it looks okay. All right, now I'm going to tell you that because as a trader, right now we have to be forward looking, but right now it looks okay because this is the oh my God, crypto is dead again moment at 69K as long as the bond market is behaving. Okay, the 10-year has to behave. And we're going to deep dive in on that today. All right, it's very important. You may think it's boring. Some people say, I don't even know what this chart is. Well, you better get familiar with the chart. And you better get familiar with the 10-year yield. Because I told you in other videos, the 10-year decides everything. Now, the Fed has got some tools in their toolkit that they can use to actually manipulate it. And we're going to go over that because you need to understand that. So as you're reading, say, Barron's or the Wall Street Journal, or maybe more some people that are more sophisticated in crypto that just don't talk about Fibonacci retraces and, we're in a bearish triangle or, head and shoulders. No, of course, all those patterns have their place, but you need to understand the macro behind the pattern. Okay, you could say all you want about a bearish wedge or a rising wedge. You could say anything else, but if the macro switch, you could forget about everything. All right, so that's why it's so important for you to get comfortable with a little bit more deeper analysis. Then that's what we tried to do here. We don't just dip your foot into deep analysis or your toe in. We throw your whole leg in up to your kneecap, potentially even up halfway up your thigh. Okay, so that's what we do here. All right, that's why we're a little bit different. So 69K is a max fear entry right now. Historically, it's where smart money rotates very quietly. Now, again, as I said, you don't choose the path. We can't choose the path. The market, we're at the mercy of the market, okay? But you can choose your positioning. All right, now let's get into the 2-hour chart, the infamous little 2-hour chart where we do our breakdowns. All right, look at Bitcoin. It has been quiet, right? Because we're on the eve of the potential rate cut. Now that's sitting up. Where is that at? Like almost 88% right now. Hang on, let's check it out. Right now it's sitting at 89.2%. Okay, that's good and bad. So the likelihood, of it happening is very good. The question is if they don't do it, because now everybody's on one side of the room right now. So it's going to be a trading market. I'm not saying Bitcoin is going to collapse because of it, but it will go into a deep dive, potentially testing that low at 74,000 if they don't do it. Okay. Now, eventually they will do it. And look, everything's pointing to them doing it. But you got to be prepared for that skunk Powell. All right. Now, they have other tools, and I'm going to go over those other tools to actually inject liquidity into marketplace. The Fed, federal funds rate really, yes, it's like an indicator. It's kind of like jawboning. They're basically saying the economy, it needs liquidity. However, there are other ways they can do it, but you just got to be prepared. So it is going to be a trader's market for sure. So again, we suggest that you join our pro group. Also, don't forget, I forgot to mention in the open that January something big is coming for you guys. So make sure you stay tuned for that as well. But anyway, so right now we got 89.2%. Let's get into our short-term chart and let's go over our chart points right now. Now, it's not your normal everyday market, obviously, because, we got that big rate decision tomorrow, right? So as it stands right now, Bitcoin's sitting right at 90,000. All right. So 87,000. This level is still good short term as a support. 87,000. Let's call it 87,000 even. All right. Give it a little room for like skid right now. Also 91,232. Very, very important point. If it can get over that and sustain a break above, say, all right, I'll go with Frank's point. 93. If we can stay above 93, that's good. That could set the ignition off up into 96, 95, 96. If we hold above that, then Bitcoin's going to start to try to attack the 100,000 level. But as it stands right now, your most important point right now is the 87,000. A break of 87,000 actually opens up a shelf down to, I would say, like, yeah, I would go down to 83,744. It would open up that solid right now support shelf, of course. Next level of support's at 82,000. If that breaks, then we're looking at the 80,600, the recent low that we have, and of course we have the main support at 78,241. Now, if they don't cut rates, I'm looking for a dip down there. Market will actually puke. All right, but uh, I'm going to go over. There are other things they can do to inject liquidity. So the knee-jerk reaction off of the uninformed would be, hey, sell, puke everything. It's going down. We're back into the crypto is dead again scenarios, right? But that's not the case. And I would actually argue, I'm going to take heat for it, but I would argue that really there's no real need to cut the rate. Now, it's a great signal, but in reality, as I showed you in the other video, like liquidity is expanding and that's going to work its way through. I'll bet slowly it will work its way through. But everybody's waiting for this cut. So I know I'm going to take heat for that. They're going to say, Tom, you're absolutely out of your mind. I'm not. I just been around a long time and I know the way markets react, and you got to watch the bond market. Okay. So we got Bitcoin now that's dipped towards, like, say, 89,000. I have to briefly touch at 92. Classic pre FOMC chop right now. Whales and long-term holders are pulling Bitcoin off exchanges. Multi-year low supply levels are out there right now. It's textbook quiet accumulation right now, and analysts are already calling for a potential holiday squeeze. Now, let's see what happens. Now, we also have, one of the big guns in crypto, CZ, basically saying that he predicts multiple, many more all-time highs coming soon. I don't know exactly when, he says. Oh, congratulations. Neither do I. And I don't know exactly when we make a deepest low that we got. That's just part of the game, right? Well, at least he's being honest there. He's not coming out saying he's a GAN guy saying, like, in 47 days and 30 minutes, we're going to get a breakout upward. There's a little GAN, like, twist for you. I'm telling you, GAN has never been accurate. But anyway, he said that, Bitcoin's all-time highs are coming soon. Bitcoin ripped up 4K. Coincidence? Maybe. I don't know. But ignoring really one of the most connected men in crypto, I don't know. Would I trade against them? In the long run, no. But in the short term, yeah, of course, I would, do my shorts and longs, whatever I got going. But really, it's not really too smart to trade against them. So now he may have noticed some insights that we have noticed as well. I'm going to take you over to good old Bitcoin here. And what we're looking at in Bitcoin here is the cycle really didn't break. It inverted. And really, nobody noticed it. Okay, so for the first time in history, Bitcoin broke its all-time high before the magical halving. Okay, not a bull market signal, like a reset. 2024 wasn't euphoria, it was really political repricing. A macro trade on regulation, not retail mania, okay? There was, because we got all the big boys coming in. Then 2025 comes in. We got 3.5 billion in ETF outflows, Bitcoin dominance at multi-year highs, altcoins collapsing in silence, a 36% drawdown with fear at 80,600. This wasn't a rally, basically, it was compression, right? So we got compression that's coming into the market. And, everyone's calling for the bear market right before the liquidity comes in. We said this before. So if I take you to the chart, right, look at global liquidity. We're watching it. We're watching gold, all right? Global liquidity is about to explode. Now, why we say that? Fed repo inflows, right? You got the Treasury, cash. You got China, Asia, stimulus. We got credit that's easing. We looked at the credit default swaps yesterday, which was good. Bitcoin made new highs with absolutely no fuel. Altcoins, we said, haven't even touched the runway yet. Now, for the real meat of the show. This is the real meat. This is where you're going to want to get your number 2 pencil out. And you're going to want to take some notes and then like go back and check what good old Tom, your boy Tom, is telling you here. Find out if he's just full of duck feathers or not, or if he's got some validity in the old crow's head over here. All right, this is the part that nobody outside of finance is going to be talking about. I want to talk about really, you know, well, that's the most important part. But right now, I want to talk about this. Okay, global liquidity. The Fed has multiple tools that expand the balance sheet without ever admitting that they're doing it. Now remember, QE's got a bad name, all right, because it's inflationary, and it has a bad name on the CNBC talk show. It's Kramer, all those guys, they bash QE, right? Now, we're back to QE, but they don't need to buy bonds openly. They don't need a press conference. They don't need political permission. Liquidity could appear quietly, invisibly through the plumbing of the financial system. Oh, so how do you do that? How do you do it? Well, if you're a banker, you'd understand everything I'm going to talk about right now. And you could go and ask Grok or ask ChatGPT, since they write my scripts, according to you guys. You could, go and find out what a falling repo rate means. When the repo rates get cheap, it means the Fed is easing funding pressure. Now, you're only going to know that if you're sitting on a bank money market desk and they announce certain things like reverse repo, reverse repurchase agreements. It starts flashing on their screen. Beep, 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 beep. All of a sudden the news comes in. The Fed has done, they actually did reverse repos. Okay, you're not going to know about that. Now you'll read about it perhaps in the Investor's Business Daily. So then all of a sudden you'll start to pick up on what it means. Oh, yeah, I remember Tom talked about that, right? So when repo rates get cheap, it means the Fed is easing funding pressure. That also helps bank make a rise or an accumulation in bank reserves. This is liquidity. Banks suddenly have more ammunition. Okay, now what happens is you get an expanding balance sheet, okay? Even Powell, okay, he avoids the term QE, okay? But there's another thing that they can do, and it's called an SPV, Special Purpose Vehicle. Now, what is that? Well, it's a separate legal entity created by the Fed and the U.S. Treasury, and it's designed to buy assets, to lend money, or provide emergency liquidity. So does it sound like kind of like they're manipulating the market? Yeah, it does. Have they done it before? Yeah, of course. Okay. Now, the Treasury puts in equity capital. The Fed lends against that equity. Then all of a sudden, that special purpose vehicle suddenly has hundreds of billion dollars to support markets. Don't you wish we could do that? I mean, isn't that insane, right? But that's what they do, folks, okay? So this is quantitative easing, but through a side door, using corporate credit facilities, emergency lending, this stuff from 2020, but very, very quiet. Now, here is where it is, where I said the beep, beep, reverse repurchase agreements. That you're going to find out on a bank desk. Okay, and this is the biggest one they can do, because money market funds park cash in the Fed's overnight facility, which is the RRP. Okay, now when the RRP drains, that cash flows back into the system. Now, this is the quietest way that they can actually do this. Money market desks move cash out of the RRP and into T-bills. The Fed encourages this by lowering the RRP rates, changing collateral rules, adjusting incentives. The result will be reserves will rise, liquidity will rise, and crypto pumps. This is the stealthiest form of balance sheet expansion. Okay. Now you can also look at repo injections. The Fed can inject 100 billion to 500 billion in liquidity through repo operations. This increases reserves, but it doesn't make the headlines either. Okay. And every time they do this, crypto reacts first, because Bitcoin prices liquidity, not earnings. When liquidity rises, Bitcoin leads, Ethereum follows, altcoins lag, then blow up. Risk gets outperform, you know, risk gets outperform. Okay, so for 15 years, this has been the no quibble guarantee or the ironclad guarantee, or however you want to look at it, right? The no quibble guarantee, all right? No quibble refund, however they say it in Britain. But anyway, right now, so I want to bring something up, okay? Because this is what is important to understand. I'm going to move over to the 10-year, okay? The 10-year yield. Anything above 450 could crash the whole scenario. Okay, right now we're ticking up to 417. Now, a lot of people are thinking this is a breakout. I don't think so, because if I took you to Trueflation once before, I think that this is just a little bit of the bond market being a little bit nervous right now. I think it will calm down. But what can the Fed do? Well, when they do the RRP, when they do the reverse repurchase agreements with repo, like say reverse repos, what they're really doing is they're trying to affect the long-term yield curve. All right, that's what they're trying to do, because generally it puts indirect pressure on the long end of the curve. So it forces money market funds to move cash out of the Fed's RRP into T-bills and other short-term collateral, which frees up the Treasury to issue more bills and fewer long-term bonds. Now, when the Treasury shifts to the front end, the long-term yields come off. It's the quietest trick in the books, but we gotta watch this yield because those bond traders can get unruly. Now, you gotta understand their point. Their point is that, say, for instance, inflation's running at, say, 2.5%, 3%. Okay, they're only getting 4.17 on the bond. Right? Now, all of a sudden, if you cut short-term rates, you're giving them less money. They're going to demand more money in the longer term to basically hold these things. So I can understand their point for trading. Like, all of a sudden you cut the rates, but inflation starts to tick up. You're eating into their profits. They're like, hey, I don't want to hold this thing for nothing. What am I going to hold this thing for nothing for? You better pay me more, or else I'm going to basically rip your head off. I'm going to force. So this is why we have to keep very, very close eye on the 10-year. All right. So I'm giving you the warning. Everything right now looks good. Looks good. But we got to watch the 10-year. That is the warning. Okay. Now, we also have to notice if the Fed's going to do what's known as YCC, which is yield curve control, which is what they be doing with the repo. So they are starting to do that because they are nervous about it. So the 10-year gets dangerous if it gets above 4.5%, because it dictates what? Mortgage rates, auto loans, credit card APRs, corporate borrowing, consumer sentiment, investor risk appetite. So it's the lifeblood, basically, of the American financial system. The Fed cuts the rates, but the 10-year yield spikes on inflation fears because the Fed, they think that the only way they'll do that, I think the Fed's cutting too early. That's why I say I really don't really care if they do it or not. Now, of course, the market is pricing that in. So if they don't do it, we're still, I would rather, I don't, I mean, personally, I would rather they didn't do it. Because I want to keep the bond traders happy. I know these guys can be an unruly bunch. You may be cursing me right now, throwing stuff at the screen. I get it. But in the long run, the liquidity is here. Okay. But okay, you want the short-term rate cut. You want to, you want the McDonald's attitude. All right. I got it. I understand. You want it. You want it now. Right. Okay. So we just have to watch the 10-year because we don't want mortgage rates going up. We don't want consumer rates going up. We don't want corporate financing to get more expensive because it affects us. Every time the 10-year yield spikes, S&P takes a dump. That's also meaning that we're going to take a dump. All right? So we just got to watch it. Now, again, volatility is going to spike in this thing. Alts would puke if this thing actually comes back up, and the risk appetite would evaporate. Because really, it's the bond market, not the Fed, that controls the real liquidity cycle as far as the short-term rates are concerned. So just keep that in mind. It's the 10-year, all right? I have that written on my chart. I have that written across the top of my screens. It's a 10-year, stupid. Watch the 10-year. Yes. Okay. All right, now let's move on. Go over Ethereum. First, let me move on over to that chart. Is a short term on Ethereum. Spiked right down to good old Tom's support level, bounced right off of it, and now it's actually stabilizing. Okay, so right now as it stands, Ethereum's resistance 3,240. That was also the close of the spike downward that we had right here. Okay, it was a close of this bar in here. Very, very important point. Look, it's the demarcation line of the breakdown. So if we can get back up over this, because that's what ChatGPT told me, that you got to look at the closes, right? And give me a whole outline for that stuff. So anyway, you get a close below this with a little bit of spike upward, like hold this level, we can get a run to 3,005. Now that would be good. That would be like an ignition for Ethereum. However, what I expect, if we could survive this, we get the rate cut as we are anticipating. We get Bitcoin to take off. It's going to affect Bitcoin dominance and all that other stuff. But if we could take this top out without creating a new low, that is the key. If we could take the top out without creating a new low, good old Tom thinks it's a buy, it's a breakout up to 3,532, and I will be taking that trade. Okay, I'll actually be buying a little bit of dips down to this shelf down in here as well with a stop below this pin that actually happened. But that's what I'm thinking. All right, so let's get on. Like, if you think, like, Ethereum itself just flashed a signal against Bitcoin. So every bull run in Ethereum flashed the same way. 50 EMA reclaim, bullish retest, explosion. We just did it again. Now, this could help alt season, okay? Because now we can say we're starting to see it. All right. Last time it was just hopium, like we're looking into the charts, trying to figure it out. But really, this is like the beginning. We could get the Ethereum bull market run as long, like I said, if we get through 3,500, like first level is 3,250 or so, but then 3,500, then we can actually see it. So, if we look at Bitcoin dominance, I mean, we told you this is going to be tricky, tricky, tricky. Well, before I get into that, we're in the same spot that we had a 200% pump. Ethereum versus Bitcoin. So we're in the same spot right now. So before I get into Bitcoin dominance, I wanted to just show you that chart. I kept it up for a reason. So I got to use it, right? So let me go over to Bitcoin dominance. Slightly up on the day right now at 59.20. Yesterday was like 59. We told you that Bitcoin can actually, dominance can go back up. Like, right now, it's a head fake on any type of movement downward is a head fake in our opinion. We're thinking Bitcoin dominance actually go back up to 60. If Bitcoin takes off, it's going to be the center of the show. Then once the dominance starts to fall off, that's the real move. So you gotta actually, this is the point that you should be looking for altcoins right now that are good utility coins. And again, you should be getting into our pro group. And so how do you get into this pro group I keep talking about? Well, the link is in the description right here. You click this link, be taken over to our pro Telegram trading community. We drop insane alpha trading opportunities daily. Don't forget, January, we got something big coming for you guys, so make sure you stay tuned for that. Also, if you want to go it alone, I get it. We offer 2 links to 2 superior brokers right here, offering really good bonuses through our links. So check them out if you want to go it alone. But I do suggest that you join our pro trading community and get in on all the action. Like I said last week, 71% win rate. All right, let's go on back over to altcoins, where we're finishing up for the day. Now we look at the altcoin market. All right, is alt season canceled or about to begin is the question. Now, Total 2 just formed the massive head and shoulders. I told you the patterns are the patterns, but the macro running in the background makes the pattern. Okay, so we break it and we end in a bloodbath. Okay, if we reclaim it and we launch, it would be what would be considered the pivot and the move outward. And most will react late. You got to be in, but you don't have to. You, like I said, get it. Make sure you pick some good coins, because really right now alts are mixed. It's cautious. It's really early rotation. We need Bitcoin to stabilize. We need Ethereum to start to outperform. Right now, alts are lagging, and then once those things happen, alts will explode. So we're somewhere between stage 2 and 3. But the sentiment is still cautious. Now, the one thing we could look at is stable coins. Stable coins peak, and then altcoin, it marks the entries for altcoins, right? We've seen it 3 times before. Parabolic move into resistance. Stochastic RSI is topping out. Altcoins are bottoming. And you only recognize the rotation once it already started. But again, you got to pick. You got to pick the right coins, the good utility coins. All right, so we're wrapping up for you today, Crypto Crew. So right now, as it stands, the Fed, right now, we're looking at the potential rate cut. We got the three scenarios that are going on right now. We got to watch that 10-year bond yield, man. If that thing revolts, we got to get prepared to actually look for a downturn in the market, all right? So if the 10-year behaves, liquidity flow is very nice. Nicely, risk assets will cover. We'll have these perfect three scenarios in place. If it doesn't, we're, we could end up in a carnage right now. It's been, Bitcoin itself has been pretty difficult this year, right? Because really, as it stands, it's a total trader's environment right now. But if we get the Fed that injects liquidity also quietly through the RRP and repo, crypto is going to move fast. So just watch the 10-year, man. I'm giving you the warning of the 10-year. All right, that's it. So make sure that you come on over to X. Follow us on X, where we talk about Bitcoin, crypto all day, every day, because we are cryptomaniacs. So what do you got to do? Well, you got to remember one thing. Bitcoin is at the pivot point. Three scenarios, one decision. Fed is quietly prepping the pipes for more liquidity. The 10-year bond holds the real power, but we are in a trading environment. Fast, reactive, asymmetric, everything there. So make sure that you consider joining our pro group to help you out. What else you got to do? You got to do your own research. As you know, I'm a trader just like you. I don't work for Merrill Lynch. I'm not a financial advisor. Okay, what else you got to do? Well, as a short-term trader, you got to enjoy the party, but dance near the door. I'll see you in the next one. Cheers.